Hello there, this is the Bookkeeping Master on YouTube. Welcome so much to this video. Thank you so much for being with me today. This presentation is all about improving company cash flow. It doesn't necessarily have to be a company, it could be a charity. Improving entity cash flow. So if you are a business owner, if you are an entrepreneur, if you are a company director, perhaps a financial controller, a finance manager, a bookkeeper, an accountant, if you are an investor, if you are a business student or an accounting student, then this video is for you. Now, the really interesting thing about cash flow, especially or more specifically cash flow difficulties, is so many entities, so many businesses and companies struggle with this. Now, a lot of the businesses that I've worked for in the past have at some point, either for a period or continuously, have faced cash flow difficulties. So if you are some sort of business owner, director, accountant, financial controller, whatever it is, this video is going to teach you ways to help improve a company's cash flow. So it's going to be full of a number of tips and advice that I can share with you that could improve company cash flow. You should know what cash flow is. Cash flow is the available cash within an entity. If a company, charity, business, whatever, is struggling with cash flow, what they're saying is they don't have enough cash in the business to pay its bills or meet its needs, to meet its obligations. Like I said, cash flow difficulties can be very difficult. Now, cash is king. There are two things that I mention a lot in my videos. The first is accounting is the language of business, because it is. I recently uploaded a series of videos about analyzing financial statements. I really suggest you go and watch that. I talked about that in that video. Accounting is the language of business. If you want to be successful in business, it's important that you understand the basics of accounting, especially financial statements. And you can learn all about that on my website, which is there, freebookkeepingaccounting.com. So that's the first thing I always mention when it comes to being successful in a business, is accounting is the language of business. The second thing I mention a lot is cash is king. If you are wanting to run a successful business or be part of a successful business, invest in a successful business, then you need to understand that cash is king. You can have the most profitable business, but if it runs out of cash, even though it's profitable, it's not going to meet its obligations and it's going to go under. So cash and having surplus cash or enough cash to meet your needs is crucial with regard to survival of a business. Okay, so if a company is facing cash flow difficulties, what advice can I share with you? What tips do I have to share with you in this video? The first thing I will mention before we go into those tips, and sorry for all the waffling on, the first thing I will mention is that remember that these tips are very generalized. They might not be applicable to every business and every industry. The other thing to mention is some of these tips are ideals. Some of the things I share with you will be an ideal. Some of them you will think will be impossible to implement. The thing about in ideals is sometimes they don't always fit perfectly, but if we're aiming for the ideal, then we should see vast improvement in what we're trying to achieve. So what's the first thing to share with you? It's this slide here. Is the company making a profit? So is the company making a profit? If you have some sort of entity that is not making a profit, that can have huge strains on cash flow. There's a couple of things to mention here. Some businesses don't necessarily have to make a profit to have sufficient cash, because they could have investors and people funding the business that keep plowing money into the business. So you don't necessarily have to be making a profit to experience good cash flow. The other thing to mention is lots of new businesses generally experience losses in the beginning. It can take some businesses 2 to 3 years to start making money. So once again, if that business has been planned for correctly, there should be sufficient cash to get through that losing period, that initial losing period. But this is the first thing to always review on a profit and loss if the accounts have been done. Is the company making a profit? If it's not, that will have or could have significant impact on company cash flow. And if the business is not projected to make a profit anytime in the near future, that could put an even greater strain on available cash. So this is the first thing to review when talking about cash flow. Is the company making a profit? Now, if it's not making a profit, creating a profitable business is a whole other video. That's something that can be discussed and debated, and goals can be set and things like that. I'm not going to cover that in this video. I'm just trying to help you identify where cash is and how you can improve cash flow. So is the company making a profit? Yes or no? Carry on with this presentation because all the slides are going to be applicable whether the company is making a profit or not. Now, this second slide is probably the most important slide in this video, and that is to identify the cash flow issue. If a company is struggling for cash, the first thing to do is identify why. Why is the company struggling for cash? It might be one very, very specific issue, or it might be a number of things that need improving that overall will help improve cash flow. Now, the best thing to do here is to create a cash flow statement. A cash flow statement is very different to a balance sheet or a profit and loss, because a cash flow statement will show you where the cash is going each month or each week. So if a business is struggling with cash flow, then create a cash flow statement. That's the thing that you need to do. And creating cash flow forecasts can also help to stagger cash and help cash flow in coming weeks and months. Now, if you don't know how to create a cash flow statement or cash flow projection for forecast, then head over to my website, freebookkeepingaccounting.com, and there are free videos there all about cash flow statements and cash flow forecasts. So you need to identify where the problem is. If you know where the problem is, where the issue is, then you can start correcting that. It's no good saying we have cash flow difficulties and then not knowing the reason why. You cannot fix something unless you know why. Now, this may seem very obvious, but you'll be surprised about the amount of businesses I've worked for and with that don't actually know why they're having cash flow difficulties. Like I said, if you don't know, then how are you going to fix the error? Now, one of the common reasons why people have cash flow difficulties is debtors. So that's clients or customers that owe the business money. Sometimes this debtors balance can really build. If you have a healthy debtors balance, then that can really help improve cash flow. And then vice versa, if you are letting your debtors to build and build and build, that's all sitting as debt on the balance sheet, and that money's not flowing in to the business. So debtors is one of the first areas that I always look at. Now, there's a number of points here, such as approving credit. This is generally not done in a number of businesses. Approving credit is a great way to start managing debtors. So if a customer or client wants a credit account with the business, make sure that there's some sort of procedure or policy in place to approve that credit. And that's generally done with some sort of application form. And then the business is checked, has some sort of credit check or background check. Now, this can really help reduce the amount of bad debts. Now, bad debts are horrible for a business because they're an expense and they lower business profitability, but they also have a negative impact on cash flow. So approving credit is a great way to start managing that debtor's balance. Another thing is credit limits. Now, credit limits work fantastic for a few reasons, fantastically for a few reasons. The first is they can reduce bad debt. So if you have a customer that's not paying, it's much better that their credit limit's set at 2,000 and they only have a bad debt of 2,000 rather than they never had a credit limit and the debt builds up to 20,000. And then suddenly you've got this huge bad debt that you need to wipe off that you're never going to get your money for. So it can really reduce bad debt. So it limits your risk. It limits the amount of debt that's going to be exposed to one client. And one of the great things about credit limits is it enforces payment to continue trading. So if you have a customer that's reached its credit limit, say $5,000, pounds, euros, it has to make a payment in order to continue trading with you. So it enforces this sort of automatic payment process where the risk is limited and the customer has to make some sort of payments in order to buy any more goods or services from you. Now, this might seem like very basic stuff, but believe me, this is not implemented in a number of businesses, and sometimes it is implemented but not taken seriously. Number 3, ensuring sales ledger is accurate. If the sales ledger is not accurate on a weekly basis or daily basis, then that's going to waste time for the credit controllers and those in the sales ledger department. If it's up to date and accurate, then those chasing debts and payments will have accurate information to work from. Invoicing customers ASAP, as soon as possible. If you wait a week to invoice a customer, that's a week later that you're going to get payment. Invoice customers as soon as possible. If it's a large business, they should be invoicing every day. Get those invoices out. Now, I once had a business that I worked closely with, and they had someone in that just raised invoices. Their task every day was to raise invoices for customers on behalf of the business, which was fantastic. You know, they had someone in that could raise invoices straight away. But what happened was this person who was raising invoices upset a company director. Company director got rid of this person. They got sacked and they never replaced them. Well, they did eventually replace them, but they didn't have someone immediately to take up that role. It took them about 5 or 6 weeks to get somebody in to replace that person that raised the invoices, but the company actually nearly went bust in that 5 or 6 weeks because there was no invoices going out. They still had to pay wages, they still had to pay the rent, they still had to pay suppliers, but no money was coming in because no one was raising the invoices. So that just shows how important raising invoices is. Reviewing payment terms. The tighter the payment terms you have with your customers, ideally, the quicker payments will come in. So if you have 15-day payment terms with customers, that's obviously a lot better than 60-day payment terms because money is going to come in a lot quicker. Invoices are going to be paid a lot quicker. So review payment terms. Now, it might not be tactful to review payment terms with big clients that you've been working with for a while. If you turn around and say to them, well, you're on 30 days and we want to move you to 15 days, you know, that might not go down too well. And the last thing you want to do is lose sales when you're trying to improve cash flow. So it could be that you review payment terms for new clients coming on board, that you start making your payment terms stricter. Or it could be there are some customers that you could review payment terms for, existing customers, and make them a bit tighter. Chasing debts. Have someone chase debts by phone, by email, by post, whatever, get the money in. I once worked with a business that had no one assigned to chasing debts, and they were having huge cash flow difficulties. Within a few months of having someone chase debts, the business was literally transformed. They were in their overdraft by about £10,000-12,000 before they got someone in to start chasing debts. Within about 6 months of someone chasing debts, their bank balances were more like £15,000 out of that overdraft. It makes a huge difference. And then legal action. If you don't have customers that aren't paying, have some sort of procedure in place to start legal action. Once again, some companies have this in place, but they don't take it seriously. I guess to summarize all the points on this slide, credit control policies and procedures. That's all this is. It's having some sort of sales ledger policy, credit control procedure in place from new customers with approving credit and credit limits all the way through to customers not paying and starting legal action. Okay, another reason why so many companies may struggle for cash flow is surplus inventory. Now, this is very common amongst new businesses. Is they're going to open a shop or they're going to sell stuff on eBay, whatever it is, and they purchase so much inventory, so much stock, and they can't sell the stuff. They got surplus inventory. If they can't sell it, that's real bad news. But just having surplus inventory that's going to take 6 months to sell, a year to sell, is going to have a huge impact on cash flow. It's much better to have that money in the bank that can help the business in other ways, rather than it be invested in stock that involves cost to store, and you can't really do anything with the stock until it's sold. Now, there's a couple of things that I suggest here. Number one is business planning. If you're starting a new business, have a business plan where you know how much inventory, how much stock you need to buy. That may prevent you from having a surplus amount of stock and experiencing cash flow and also or cash flow difficulties from that, and also an increase in expenses. It impacts profitability. Number two is review and production. If you've got a big, manufacturing company and you want to look at the inventory, then reviewing the whole production process, having some sort of cost accountant, something like that, is a good way to manage inventory. Creditors. So we went through debtors. Now we have creditors, people or suppliers we make payments to. Payment terms is the first thing. Try and agree better payment terms with creditors. So if you have some creditors that are demanding 15 days payment, try and boost that to 30 days. A lot of them will accept an increase in payment days because they want your business, especially big suppliers. Even if you can boost payment terms by a week, it can have a huge impact, a positive impact on cash flow. Debtors versus creditors. Now, in an ideal situation, your debtors' payment terms will be tighter than your creditors' payment terms. So ideally, if you are invoicing customers at 15 days and then your creditors are invoicing you at 30 days, you have a great positive impact there on cash flow, or potentially a great positive impact for cash flow. Try and have your debtor days much lower than your creditor days. And once again, this is a big task in itself. It all needs reviewing. I'm just teaching the principle here. Credit limits. Increasing credit limits with suppliers is a great way to help cash flow. If you've got a $5,000 credit limit, try and push that to $6,000. And if you can do that with all suppliers, you're having much more credit with creditors, and that can save some money out of the bank. Now, obviously, if you're having greater credit limits or larger credit limits with suppliers, you're going to have a lot more debt, a lot more money owed to these creditors, which isn't necessarily a positive thing, especially when you're looking at a balance sheet or the health of the company. but I'm talking about cash flow. You know, if a company is struggling for cash flow, sometimes the priority is to get the cash in the bank rather than not overexposing a company to creditor debt. Directors and shareholders. Now, for small businesses, this can be a real issue where the owners of the company are just taking too much money out of the business and the business suffers. If it's a limited company, shareholders should be keeping a good float of retained earnings within the company. If they're just withdrawing all profits, if they're taking dividends of all profits, that's going to have a negative impact on cash flow. I can understand why they want to do it. It's their money. They want it in their personal account. They want to go and spend it. They want to pay their mortgage off, whatever. But having a healthy float of retained earnings can really help cash flow. Now, if you're an employee, you can't really bring this up with a director or a shareholder. But if you are the business owner or a potential investor, you know, this is something that can be discussed and agreed on, is to have some sort of float within the company of retained earnings. Now, salaries is another. I know some directors that pay themselves huge salaries and the business suffers. Once again, I can understand it, but if we're trying to improve cash flow, that's not going to help. So that's something else that can be reviewed and improved. Now, the last slide here is sales and expenses. This one's obvious, and I've left it to the end because you know, this is so much more easier said than done. If a company is struggling for cash, improving sales, you know, is obviously a way to improve cash flow if there isn't a cost involved in improving sales. It's easier to say go and improve sales. How you do that, you know, is for another video. Same with expenses. Negotiating cost of items and overheads within a company, that can be a way to improve cash flow. If you've got less expenses, you're going to have a more profitable business, but hopefully more cash in the bank. So reviewing expenses, things like wages, overheads, rent, cost of goods, whatever it is, if they can all be reviewed, and even if you can save some money by reviewing and negotiating, that's some more money in the bank account that wouldn't be there. Okay, thank you so much for watching. Hopefully this video has helped. I do tend to waffle on a bit. These videos aren't really scripted. I have my slides obviously, but I don't plan on what to say. I don't have a script in front of me, so I do apologize if I've been all over the place. But thank you for watching. If this video has been helpful, please like and subscribe. If you're interested in more videos, I have hundreds of videos. They're all for free. They're all about finance, bookkeeping, accounting. They're at freebookkeepingaccounting.com. They're on the slide. All the videos are for free and no registration is required. Thank you for watching, and I'll speak to you in a future video.